Welcome to No Fluff, Just Ideas. This is your host, Sophocles, and we're going to be discussing investment ideas from around the world. So buckle up and enjoy. This podcast is for educational purposes only. Full disclaimer at the end of the podcast. So I'd like to welcome Samir Mohamed. I've known Samir since 2016, since he came to my first value investor event in Nicosia, and he's been coming ever since. He was very helpful to me organizing an online event, which I'm doing next week, actually. So if you're interested in listening and viewing and chatting with 12 fantastic fund managers and experts, please go to fatalphavalue.com/online. I will post also the link on the Substack. The Substack is fatalpha.substack. I put a lot of work into the online event. I think it'll be really great. We have a wide variety of topics. But anyway, let's go to our topic and our main man here today, Samir. Welcome. Thank you for doing this. Samir is a fantastic full-time investor who has been focusing on commodities over the last few years, and I can't think of anyone better to talk gold with. And gold has been making new highs, so I think it's a great time to see if this might be interesting to to myself and also to any of you listeners or viewers. All right, so Samir, thank you.
Thanks for the kind introduction. So looking forward to the podcast.
So tell us, give us your summarize the pitch on G mining for us, and after that, I want to go into gold.
All right. So G Mining is a gold mine development company. They have successfully developed their first gold mine in Brazil that went into production in the third quarter last year. And they have a very good track record. The family founding the company has a very good track record in building and developing gold mines. And they now continue with the second gold mine that they will most likely start construction this year and then go into production in 2028. And in addition, they also have a third asset that is currently in the exploration stage that they could develop midterm. And the interesting thing here is that with G Mining, you have a really high growth gold mining company, because they go from a bit less than 200,000 ounces of production with the first mine to more than 500,000 ounces of production from 2028 when the second mine goes into production. So you get leverage to the gold price, but you also get basically organic growth, because they already have the assets, they just need to develop the mines.
Wow. But of course, as a gold miner, they're highly dependent on the underlying, which is gold. So tell us, why gold? Perhaps even why is gold going up so strongly? And just give us some general thoughts on gold, please.
Sure. So over the last, let's say, 1 year or 2 years at least, there has been an increasing concern about debt levels and deficits in several developed markets. So you have a lot of countries, especially Western countries, that have record deficits and debt levels. And in addition, they also have even higher unfunded off-balance sheet liabilities, for instance, from their pension systems or their healthcare systems. I mean, as an example, for the US has a bit over $36 trillion in debt, which is about 120% of GDP, but it has about $100 trillion in unfunded liabilities off balance sheet, which is to a large extent from its public pension and healthcare system. And of course, investors say, okay, how can this situation be managed? And how it's often managed historically is if a country has debt in its own currency, it can basically print the currency to pay off the debt. So that means the central bank can buy the government bonds and keep interest rates at a certain level if they want to. And of course, this over time then devalues the currency. So that is a significant risk. And I think an increasing number of investors have started to realize that over the last 1 or 2 years. And the US is here just an example. There are also many other countries in Europe that have significant debt levels and risks here. And that's why I think it has become also much more to the awareness of investors that this is a risk. The second risk, which is linked to that, is actually that inflation might come back. It's the narrative that inflation has been beaten, that quite a few central banks have been trying to sell, I think is premature, especially if you look at the situation now also with trade. If you introduce trade barriers and tariffs, that typically makes supply chains much less effective, much less efficient. That means the costs increase. And then you have also a situation where a lot of countries, especially in the West, say, okay, for geopolitical and strategic reasons, they need to reshore supply chains. But that leads to a significant cost increase, because the reason why in the first place a lot of companies offshored their supply chains to China and other Asian markets was because of much lower cost. Yeah. And if you now take this back, then you just have to accept that your production costs will be significantly higher typically. In addition, several countries, especially in Europe, still have these energy transition policies, which, if you look at it in more detail, actually turn out to be costly. That's why they still need subsidies. And as a result, a lot of countries in Europe have really high energy costs. And that is also a structural driver. And then the last, I think, driver in particular for inflation is also demographics to some extent, if you look at the labor force, because in a lot of countries, the labor force is either not growing that fast anymore, or it already started shrinking. And this, in turn, is driving wages up. And then maybe another point, which has been especially important since 2022, is that a lot of central banks, especially non-Western central banks, increased their gold purchases. And the reason for this is for sure that they realized after the foreign central bank assets of the Russian central bank were effectively seized, that it's not a good idea if you have treasuries as currency reserves that might be confiscated in case of geopolitical reasons, or in case geopolitics changes. So for sure, China, for instance, has a high incentive to actually switch its reserve more from going away from owning US treasuries or foreign, let's say at least Western country treasury bonds to gold. So we saw significant purchases of gold by central banks over the last 3 years, of typically more than 1,000 tons per year. So these are, I think, the three main reasons why gold is more interesting.
I'm going to ask a stupid question, because I'm thinking, if there an alien came and knew nothing about the planet Earth, and he'd probably be surprised and say, well, what's this obsession about this, shiny yellow thing? Doesn't seem to have much use case. Doesn't seem to be that rare. It seems that there's other metals which are rare as well, but doesn't seem to have the attractiveness or the popularity of gold. So it seems it's sort of like gold has just become like an idea, the idea of it being something that's been around for thousands of years, and somehow we've associated that this is something very valuable, So I think, I hope you can indulge me for a second if you had any thoughts on that basic?
Sure. I mean, it's not like an industrial metal, where you can say, okay, copper is used for certain industrial products, so people are willing to pay for it because they need to use it for cables or whatever. So it's the primary use case is monetary and some jewelry. And in that sense, it's purely an abstraction. I agree. So basically, it is what it has the value that people attribute to it, but it's not like you can prove, okay, this is exactly the value it should have, The reason gold developed as a monetary metal is because it has some attributes that made it superior compared to other types of money. As an example, previous cultures many centuries ago were also using seashells or other things as money. But the issue was that if you can increase the supply relatively quickly of something that serves as money, it gets devalued very quickly. So for instance, the seashells, if suddenly you can manufacture them, then the value of the seashells dramatically drops. So it turned out that gold is really difficult to find and difficult to mine, and it has been difficult to find and difficult to mine for thousands of years, and that's how it somehow established its use case as a monetary metal, because it's typically increasing by maybe 1.5% to 2% per year globally, the available gold supply. It looks like it's a pretty useful number. So it is available, but the supply is not increasing fast, and it cannot be increased very quickly. And that's also a difference to other metals where you might say, okay, if somebody, develops a big mine, suddenly the supply goes up by 20% globally, then it's not useful as a monetary metal. Yeah.
So another asset which seems to be trying to compete and may have some of these characteristics as well is, as you know, Bitcoin. So the new digital gold, as it is referred to by some people, is Bitcoin, competing against gold? Are the people interested in gold also buying Bitcoin, or are these two different groups of people? Do you have any thoughts?
Yeah, I think it depends on age group and on geography. So age group first, I would assume that at least that's what I hear, is that people who are younger rather tend to prefer Bitcoin, yeah, versus people who are in the older age group rather tend to prefer gold. While interestingly, geographically, people in Western countries tend to prefer Bitcoin, while people in Eastern countries, Asia, etc., tend to prefer precious metals, yeah, gold in particular. So it's also, there's clear differences also in terms of which culture prefers what. As an example, even in China, a lot of very young people also buy gold. Yeah, so there it's not like, okay, only older people there, it's across the whole age spectrum. And then you also have people who basically like both. Like me, for instance, I had both in the past. Yeah, I invested in both Bitcoin and gold and other precious metals. So for me, it is not a contradiction. It's not an either or. I think both try to address the same issue. They both say, okay, we're looking for something type of a monetary unit that cannot easily be debased, yeah, in terms of, devalued as a currency. And especially it cannot be devalued by politicians or central banks, which normal currencies like the US dollar can, because basically the supply of the unit is not defined by politics or central banks. I think that is the main case. And that is why I actually believe the competition is not really between those two. The competition is more between government bonds and the supply of fiat currency versus gold and Bitcoin.
I wonder if Bitcoin, for example, wasn't around, if there would have been a lot more demand for gold, and gold might have been higher just because there wasn't the flows towards
Yes.
Bitcoin.
I think it's to some extent, yes. Yeah, because whenever you have a certain amount of money flowing into assets, if it's less, then it has some impact on the price. But I think actually probably the bigger impact has been on more speculative precious metals related assets. As an example, probably more on gold mining stocks. And the reason for this is because for gold, you still have demand like from central banks who typically, at least I'm not familiar with any central bank that bought Bitcoin. Yeah, there are some sovereign wealth fund that did, yes, but not really the central banks. They don't use it as a reserve asset, at least yet officially, yeah, I would say. While gold is very demanded, yeah, from the central banks. So, however, for people who want to basically place a bet and say, okay, they want to get the highest performance possible, they might very well say, well, I would have invested in a gold miner that has a lot of upside, but Bitcoin also has a lot of upside. So why not go with Bitcoin instead? So I think it's probably more the speculative end of the precious metal investment category that has been hit or impacted by the flows than gold itself. Yeah.
And I guess you're going into the whole, gold miners. You've said to me is like a leveraged play essentially on gold. Mm-hmm. Is that why you prefer the gold miners versus just holding gold?
Yeah, I mean, I also hold some gold, but I hold the gold miners in addition because on the one hand, I do have leverage to the gold price. And on the other hand, you do have, during the life cycle of a gold mining project, there are several entry points that make gold miners very attractive. And if you really like analyzing gold mining companies like I do, you can analyze these projects and the technical studies, and you can then try to figure out, okay, is this likely going to work in terms of are the risks manageable, and do you believe the management team at the company will be able to deliver or not? Yeah. And that's how I find really attractive companies at low valuations.
What's funny is that this in itself, like you said, the feasibility studies. So for those of you who haven't seen, these feasibility studies run hundreds and hundreds of pages. So there is the possibility there of, alpha, just because no one sits and reads 500 pages of feasibility studies unless you're Samir, who does. So,
to some extent, yeah. I mean, I would say that probably most investors read the summary. Yeah. So what happens is typically a company publishes a summary of a feasibility study. That summary can be like 10 or 15 pages long. And probably 95% of the investors will read that summary. Yeah. But the 588-page study that gets published like 6 weeks later is probably read by less than 10% of investors, I would say. Yeah. And even then, what I noticed is, I suspect even the institutional investors actually outsource the analysis. And the reason why I say it is because I found several examples last year where I was reading a technical study and then updating my investment case and my discounted cash flow model. And that took me a little bit more than a week. And then nothing happened with the share price. And I was surprised because I thought the study was really good. Yeah, it was very attractive and it's all good. Yeah. And then like 3 weeks after I did all the analysis, I suddenly see significant inflows and the share price going up like 40%. Yeah. So
well, it took them, they got the study.
Yeah.
They outsourced it.
They needed a technical consultant to read the study and tell them, the 20 questions they wanted to have answered. I believe something like that must have happened.
Do you need some technical expertise to understand the 500 pages, or is that something you can understand?
I have an engineering background, but I would say, it's not, let's say it this way. Of course, it helps. If you have a technical background, it makes it easier to read the stuff. And I still don't understand everything. Yeah, don't get me wrong. If they go into details on the geology, I'm most often also at least partially lost. Yeah. But if you read enough studies over time and you try to understand, okay, what term is used and what exactly is the context of it, so you understand the different technical terms better. And I mean, nowadays, especially, with AI, DeepSeek, etc., you can also get pretty quickly the context needed to understand certain things. Yeah. Then over time, you actually understand more. And I mean, you don't need all the details. Yeah. I mean, certain things are published to basically show what type of quality control they do. As an example, for samples, etc., statistical analysis. I'm like, yeah, okay, but I don't need to understand the details of that. Yeah, I just need to know they have good quality of the data, and then it's good enough. So I think
they're not manipulated. So basically, like if I read the technical study, it's a scientific fact that isn't made prettier by management. So if I get, a good impression, then I know that it's good.
I mean, especially if they show you what kind of tests did they do. As an example, an important aspect of these technical studies is the metallurgical tests. Yeah, how much recovery can you get out of the ore? So what percentage of gold can you get out of the stone, as an example? Yeah, out of the rock. And when you then read, okay, what types of tests did they do? Then you get a feeling, okay, is it solid, or did they just very few tests and very rough and then say, okay, we are good, this is an estimate we do, yeah, as an example. And you get the feeling for this over time. If you read multiple technical studies from different companies and different consultants, you see, okay, this is now a really high quality, very in-depth study, and this one is a little bit rough. Other things I use the studies for is really detecting hidden risks, as an example. Last year, I was reading a study of a company that actually looked interesting until I got to the point of water supply. So water supply is very important for mining to process the ore. And that particular company had a mine somewhere in the mountains in Peru, but they had no local water supply, which is quite common in that area. So what they did is they said, okay, they could build a pipeline to supply the water. Or what they did is, instead of building the pipeline, which is quite costly, they said, we'll just truck the water to the processing plant, yeah, with trucks. And then I looked at it and I was like, this is a 150-kilometer distance, and the mine uses tons of water. I mean, really unbelievable amounts of water. And if you believe that you can have like hundreds of trucks trucking water to that mine over 150 kilometers over these roads, you will get problems with the local population, because the locals don't like to have this kind of traffic. And what happens very often when people are affected like this is that, especially in Peru and other South American countries, they do roadblocks. So for me, it was clear if they really do this with the trucks, there's a high risk that this plant will have interruptions because the population is blocking the road, and they can block it any place on the 150-kilometer distance. Yeah, so good luck with that. So I was like, okay, kill. Yeah, I don't need to continue looking at that company. Yeah. So for these risks, they're so well hidden, you typically find them only if you really go through the technical studies.
Wow. So that's real proof there of how the deep dive research, real true due diligence actually does generate alpha. And if it's, either it'll generate alpha or it'll save you from losing money, it seems.
Yes.
But you did mention, is there a way you could create some, long prompt which you could go into ChatGPT and ask him all these all the different based on your experience, that is, all the different questions, and it would come out with something useful? So instead of spending a week, you spend a day. Would that be possible? And have you tried it?
Yeah, I mean, what I did is I did for certain technical studies where I was interested in another company, but it had a similar type of mine under development. I did get some interesting info out of it. Yeah, I wanted to compare two different types of projects. And for the project that I didn't plan to invest in, I wanted to get certain, 10 or 12 technical parameters out of. And instead of having, to do keyword search or stuff like this, I asked DeepSeek, and it gave me a very good summary, including the context. So that was extremely helpful. That saves me a lot of time. So for this one, I would say it's very useful. I think you can you can certainly use it if you want to, I would say you still get more out of it if you read the whole study, for sure. But if you then want to get certain key data out of it, maybe later on, or if you just want to check it before you go through the whole document, then for sure use DeepSeek or some other AI and have it read. I mean, interestingly, as long as the study is somewhere published on the internet, it will find it and it will read it. Yeah, that works well.
Okay. So basically, use it when use AI to check things out, but before putting your real money to work, read the actual study. Is your recommendation.
And it doesn't have mining expertise, of course. Yeah. So you still, sometimes you get answers which are just guesses from the AI. Then you realize, oh, wait a minute, I know this one is not true. It's not reflecting reality, but I know it because I have enough domain know how to know it. Yeah.
So it can hallucinate on.
Yeah. I'm not always sure if it's all completely, maybe not completely wrong, but it's like, you could say in like 70% of the cases not accurate. And then, okay. 7-0. Yeah. Not always, but I say, if it says something, you might say, okay, maybe it got some sources where that was the case, but these sources are not representative of 70% of the cases in the industry. Yeah.
Oh,
that's
okay.
What I meant.
Okay. When something is off, it's but I guess so then, yeah.
It may have found a weird example, or other examples where I found is sometimes it just doesn't have all the info, not just for the individual technical studies, but also when I do, as an example, when I was looking for the largest silver deposits worldwide. And I asked it gave me some, which were very interesting, but I knew there were others that it somehow didn't find, but I knew about. So it's a mix.
Okay. I'm going to, before we go into G mining, I'm just curious, how did you make this shift a few years ago to, I think maybe a year or two ago, to focus so much on precious metals, commodities? Because I remember years ago, you used to spend more time on other types of companies, whereas now you're mostly focused on commodity business.
Right. Basically, the first thing I realized that was maybe 5 years ago was that I thought that we would have significantly higher inflation before we had this inflation spike then after COVID. And that is when I first started investing into physical precious metal, basically as a hedge. And later on, I was interested in some commodity businesses because I saw that they had been starved for capital. Yeah, so I was basically looking at the capital cycle and say, okay, they haven't been there hasn't been a lot of capex in a certain industry for like 10 years or more. Yeah, and this is typically a good entry point. So I was, from that perspective, saying, okay, at some point in time, there is probably a good point from a cyclical perspective to enter certain commodity businesses. That was the second stage. And the third stage was when I pivoted pretty heavily towards precious metals mining, was when I realized that the gold price had been going up, but the gold miners not, to a large extent. Yeah, like that was like 2.5 years ago. Yeah, and I realized that, I mean, either the gold price had to come down significantly or the shares of the gold miners had to go up significantly, but it was completely off to an enormous degree. And then I decided to look more into gold mines. Initially, I was, as most people would, probably looking at the bigger ones, and I thought these are not really good businesses because they have relatively low return on capital employed. They often do bad acquisitions at the wrong point of the cycle, etc. And then I was looking more into smaller companies and also found sources on the internet that were really helpful in terms of learning about the industry. And then I started going towards single asset companies and reading these technical studies and all these things, and basically figuring out how to invest in that space.
Are there any sources you'd recommend for people to check out?
Yes. One of the most helpful sources for me it's called Rule Investment Media. So Rick Rule, he founded basically an investment education company focused on commodities. He has videos on YouTube that you can find, and he also has an own website with some introductory courses on basically like lessons, like lectures on how to invest in commodity companies. And these are extremely helpful. Yeah, they're all available for free. I can send you the link afterwards, and then you can somewhat.
Yeah, sure. I can post it.
Yeah.
I can post it in the.
Yeah. So this is extremely helpful. What is also interesting is he has once a year a very big commodity investor conference that he is hosting in person in Florida, but he is also doing it as an online version since 2022. And I've then always participated in the online version of the conference. That is also very good for learning and then also getting to know more and more companies in the space.
Oh, this is the Rule Symposium,
yes,
right?
Yes, exactly.
Cool. Yeah, I've never heard of this.
Yeah.
And for the listeners, I've not been paid. But if Rick Rule would like to, he can pay me, and I'll put some more information. I'm just joking. I'm just joking. So back to G mining here. That's interesting. So gold went up, miners didn't. You got attracted into mining. And I remember you first mentioned G mining in September 23 in Cyprus.
Yes.
Where you presented about it like a fool. I didn't listen. And here we are with a much higher gold price and a significantly higher gold miners rally. I know G mining has just killed it this year. It's like 70% higher year to date, and it still hasn't reached it seems fair value. It seems that it is, I don't know if you saw that intro post I did on Substack. It compares very well to its own peers and to consensus estimates. And this is why we're also doing this podcast. So tell us, you did tell us a little bit about G mining in the beginning of the podcast. I'd like to hear more about the founders, because at the end of the day, when you're talking about not just a small gold mining company, when you're talking about any small company, I think the founders and management are super important.
Sure. So the Gignac family, they basically founded a company called G Mining Services more than 20 years ago. And the background is the father of the current CEO of G Mining Ventures, Louis Gignac. He was previously working for gold mining companies, and he was building gold mines and operating gold mines. And based on the knowledge that he collected or got out of this professional experience, he decided to found a company called G Mining Services, which is basically an engineering company that has nowadays more than 400 engineers and is specialized on basically doing engineering projects to build gold mines, as a service provider for other companies. And as such, they have been doing a lot of technical studies and then also executed projects to build gold mines. I think they have now 5 complete gold mining projects built over the last 20 years. And what is interesting about that company, the service provider, is they they have done all projects on time and on budget, or in some cases even faster than scheduled and below budget, which is almost unheard of in the industry. Yeah, it is extremely rare. The most common situation is you hear a company saying, yes, you want to have the gold mine built in 2 years, and you look at them and you say, okay, I'll add a year. Yeah, because I know they will have delays, they will cost more, so etc. So you already build in some buffer. In most cases, you will be right. Yeah, in most cases, it takes longer and costs more than they initially planned. And the interesting thing is really that G Mining Services has developed that reputation in the industry over the last 20 years that if you make a contract with them, they build it on time and on budget. Yeah, so extremely good.
Maybe they're not using trucks.
Yeah.
So okay. So they have this services company. How is that related to the miner? Did that develop into the miner, or is that like a separate business?
It is still a separate business. So it's a privately held separate business. And the way it works is if a company like G Mining Ventures wants to build a gold mine, they basically then provide employees from the services company that will then be employed by the miner, like G Mining Ventures, for the time of the project. And then they move back to the services company after the mine is built. That's how they set it up. So that also makes it easier from the organization because it's then basically the gold miner, one organization that is running the whole project and building the mine, versus having a contractor that is more or less like an outsourced service provider that is doing it for them.
Yeah. There's no conflict of interest.
No, that's an interesting one. It's an interesting one. So basically, because the Gignac family owns 100% of the services company, and they have nowadays, I think it's like 6% of the shares of G Mining Ventures. And of course, if G Mining Ventures gives this contract to the privately owned company, you might say, well, there's a risk for conflict of interest. Absolutely. And they recognize this risk. That's why they put on the board independent directors to monitor this contract and the payments, which are not part of the Gignac family, to make sure it's an arm's length agreement. They have done it now. So when they built the first mine in Brazil, they actually built it on time and slightly below budget. I don't know, maybe 1% or 2% less than they had budgeted. Yeah, and this was built from summer 2022 until September 2024. So in a time when you really had high rates of inflation, they were still able to keep it within the budget. And it's the same team that has built the first mine in Brazil that they now use to build the second mine in Guyana.
So the TZ mine, which is started operating at, what was it, fourth quarter of 24?
The first gold was in the third quarter last year.
Third quarter. And they're now looking to put money into the Oko West.
Yes.
Is that right?
Yes.
And that's the one in Guyana.
Yes.
So have they started work on that?
Yeah, what they did is, so for Oko West, they have just published in April the definitive feasibility study, which is basically the detailed technical study that is needed to build a mine. Yeah, so that one is published. That also makes all the estimates for how much capex is needed, what is going to be the production cost, the all-in sustaining cost, and all those details. They also received a first preliminary environmental permit from the authorities in Guyana in January this year. And they were then, based on this permit, allowed to start what they call early works. That is like infrastructure work, like building roads, like building an access point for a power plant that they need to build, because they have no local power supply. So they will build an own power plant, and they will build an own power transmission from that plant to the processing facility of the mine. So all these infrastructure work streams have been started in March this year. They still need to get the final environmental permit, which they expect within the next couple of weeks. The company actually said by end of the second quarter, so within 2 weeks, they expect to have it. And then they take the formal construction decision in the third quarter this year, and have then also the financing package ready to make a formal construction decision and start the construction activities of the mine and the processing plant. But they're already going ahead. So they're already planning to spend between 200 and 240 million US dollar in capex on the Oko West project this year. And their schedule says that they want to finish the mine build in the fourth quarter 2027, and then starting to produce the first gold, and then have commercial production in early 2028. So it's a very fast mine build, especially for the size of the mine.
So they have to build the roads, they have to build a power plant.
They have to build a camp facility because it's so far away from any city that you have to have workers have to be in a camp locally. So you have basically shifts like 2 weeks in and 2 weeks out. Yeah, that's how they operate these plants. That's also how the mine in Brazil operates. So they need to build all this infrastructure because it's in a very remote area of Guyana.
So how is the power plant going to work? Is that going to work? How is that?
Yeah, they are going to build a heavy fuel oil power plant, which they're going to build it at the landing site at the big river in the north, and that is about 50 kilometers from the mine. And then they will build a transmission line from the power plant to the mine site. And the reason they built the power plant not directly next to the mine is because as they have it at the landing site of barge facilities, it's basically they can have the fuel oil delivered directly there. Yeah, so that means much cheaper for them to have the fuel oil there, because otherwise they would have to load the fuel on trucks and then truck it to the mine site. So for them, it's cheaper to have the power plant right next, where they can have easy access to fuel, and then basically produce electricity and then have a transmission line for 50 kilometers to the mine site. And they have built transmission lines before. Like the mine in Brazil was also remote, and they had built an almost 200 kilometer long electricity transmission line to connect to the grid in Brazil. So they know how to do it.
And all of this development, is this done by... Does the services company then have to fly people into, or do they also find local people in Guyana to help them?
Yeah. I mean, you have some specialists that definitely need to be flown in. Yeah, some from Canada, where the basis of the engineering company, some from across several Latin American countries where they have people that work for them for a long time. But overall, they say they typically have significantly more than 90% of the workforce is local. Yeah. So like local contractors, etc., to do the construction, and then also the workforce for the mine and the processing plant. They typically take people locally and train them to work at the mine and the processing plant. So there's a lot of jobs that will be provided within the country.
So I saw in the technical study, I think it was 972 million of capex is needed.
Yes.
Is the 240 you mentioned this year, is that part of that 972?
Yes, it is. It is, yes.
Okay. So they spend the 972 and they're able to kick out gold production in 28 of about 350,000
yes
ounces per year, right?
Correct.
Okay. And we have also a third mine, right, which is in Brazil.
That is, it's basically a deposit that they acquired from BHP. The interesting thing about that one is the price for the acquisition was $0. Yeah, so all they gave BHP was a 1.5% royalty. If they build a mine that goes into production, BHP gets 1.5% of the gold produced, or money corresponding to 1.5% of the value. But they didn't have to pay anything else, yeah, basically. So this is in an earlier stage, yeah. So they already have a defined resource of 2.6 million ounces that has been found by another company that BHP acquired, yeah. So there is already a lot of drilling and geological data that is available. But the company says they want to do a lot more exploration over the next few years, probably next, I would say, 2 years or 3 years, until they then decide, okay, do we go into mine building? Yeah, so I think they will probably sequence it in a way that when the major capex for Oko West has been spent, yeah, that they say, okay, now we are ready to go and do the detailed technical studies after exploration for this third mine, and then also build a third mine out in this area in Brazil. And what is also interesting is it's a 2,100 square kilometer area, so it's a really big one. It's twice the size of the area of the mine in Brazil, the first one. So they really have a lot of exploration potential, and the cost to explore are not that high. Yeah, so they spend maybe, depending on how much they drill, $10-15 million a year. And if they can then find more gold, they can obviously build a bigger gold mine, which is then much more profitable.
So wait, did you say it was 2.6 million ounces? So that would work out, if it was 10 years, it would work out to 260,000 a year, I guess.
Yes.
Of ounces.
Yes. Typically, if you have the flexibility, you would typically target like a 15-year mine life, because that's normally the optimum in the NPV model. But I think they could definitely have something between 150 and 200,000 ounces a year. Yeah, so it would be roughly the size in terms of production of the first mine they already have running now in Brazil. Yeah. And it's
Have they done a feasibility study on that?
No. They're much earlier. They have published the resource a few months ago. Yeah, so they have definitely confirmed, okay, the 2.6 million ounces that previous operators said are there from their opinion. But they haven't even done yet the PEA. So preliminary economic assessment is basically the first economic study that gives you a very rough idea, how much capex is needed, how much gold can be produced, what is the all-in sustaining cost. I would expect that they might do a PEA or publish a PEA maybe end of next year. Yeah, but not before. And then they have to do a pre-feasibility study, and then they have to do a feasibility study. So a feasibility study is probably, I would say, end of 2028 or so, or late 2028. Yeah, and then probably another 2 years to build the mine. So I would say a mine could be in production maybe in 2030 sometimes. Yeah, 2031, something like that. So it's like a 5-6 year time horizon before they can produce gold.
Okay. So that's quite. I would say it looks like it's a free option.
It is.
At the certain point in time, a free option which costs them nothing.
Yes.
At the end of the day, I think it's, from a business perspective, I think it's fantastic.
Yeah, it's very good. Yeah, I mean, the background was BHP acquired a mining company in Australia, and that mining company had Brazilian assets. Yeah, and BHP was not interested in those Brazilian assets. So BHP announced, okay, they want to sell those assets, and immediately G Mining called BHP and said, we would like this deposit, yeah, but we cannot offer you much money.
That's great. It's great. Okay, so another thing we talked about offline was the tax implications. I remember you had told me that TZ is getting currently a special status of 15% tax. That won't be the case for Oko West, and probably won't be the case for Gurupi, which is the third mine, the free option that we talked about. How does that work? Is there a risk there as well?
Yeah.
Because this is actually something which was actually asked to me when
I noticed that one. Yeah, I mean, maybe a bit more detail on that one. So TZ is in a very remote region of Brazil, and Brazil has certain tax incentives for companies doing investments in very remote regions because they want to have jobs created there. And that is why they have this special tax incentive that gives G Mining basically a rebate from the normal corporate tax rate, which is 26%, to 15.25% for TZ. Yeah. And that is valid for the first 10 years of operation. So if the mine life gets extended to like 20 years, then at some point in time, they will have to pay the higher rate, but it's 10 years is still very good.
The higher rate would be?
The higher rate would be 26%, yeah. Which would kick in after 10 years because the special tax status is limited to 10 years of operation. Then Oko West is in Guyana, different country. They just have a regular 25% tax rate. In addition, Guyana has a 8% royalty on open pit mines and 3% for underground. Yeah, so they get quite a lot of money from G Mining when this mine goes into operation. And then Gurupi is in another area in Brazil, but I don't know the details. It also doesn't look exactly like highly densely populated, but I don't know if they could also get the special tax benefit that they get for the first mine in Brazil. Yeah, so Gurupi is really open. And then that thing was related to the question maybe, there are discussions in Brazilian politics to change certain tax laws. And the reason for this is because they spend more than, so basically they have higher expenses than expected for the government, yeah, and they need to limit the deficit And that is why now for several months, actually almost a year by now, there have been discussions in politics in Brazil to change or increase different types of taxes, like, for instance, increase taxes on dividends, if you hold shares and stuff like that. What is interesting to note is that they have not specifically targeted mining companies. So there has no, it just, if they want to increase taxes on corporations, it has been across the board. Not specific to mining. That is interesting. What is also interesting is that this special tax benefit for the first mine, the application for the tax benefit has already been done by G Mining earlier this year, and they say it will probably need another few months until this application has been processed. But once the application has been granted, I think it's very unlikely that the government will then come and say, okay, after we granted it, we now take it away. It's much more likely that they would say, okay, we do not give any future tax benefits. So maybe nothing for Gurupi, or worst case, they might decide to deny the application for this tax benefit that they have now applied for the first mine. But I think it's rather unlikely. And the reason why I believe it's unlikely is because specifically for gold mining in Brazil, about half of all gold produced in Brazil is produced illegally by so-called artisanal miners. And this is a big problem in Brazil for several reasons. One reason is it's a big environmental damage because the artisanal miners, they use mercury to get the gold out of the rock, and they just leave it everywhere, and all other chemicals and mercury in the environment. So that's a big problem for pollution, for water quality, etc. It's also a problem because these illegal miners often get into conflict with indigenous populations like local tribes. And they then, they're not, the miners are often armed, so they will just chase away the population that lived there previously. They then illegally export the gold that is produced from these artisanal mines. So as a result, the Brazilian army has tried to stamp out the artisanal miners, or at least to reduce the activities in certain areas. So they sent the army, they blow up illegal mining camps and stuff like that. But of course, the artisanal miners come back or go to some other place, very often. And the benefit for Brazil would be if they have, instead of half of the gold produced by artisanal miners, which pay no taxes and cause all kinds of problems, if they would have more, normal, regular mining companies like G Mining building mines and producing gold, because they provide jobs, they pay taxes, and they don't make environmental damage because they don't use mercury that they leave in the environment and stuff like that. So actually, I think it's not impossible, but I think it's would be really unfortunate also for the development of the country if they would now say, okay, now we will specifically also target the mining companies that operate legally, and take care of the environment and all the stuff and provide jobs, versus the illegal miners, in this particular for gold, which produce still half of the gold that is produced in Brazil. So I think it's a risk, but I think it's not an extremely high risk. In the worst case, they would have a tax rate of 26%, like the normal corporate tax rate, versus the 15.25%. So that would reduce the net present value of that asset by maybe 10 to 15%. That's what I see currently.
And Guyana, you said there were multiple taxes. It was not just the 25%.
Yes. They have. 25% is the corporate tax rate, so it's 25% on profit before tax. In addition, they have to pay an 8% royalty on all gold that is produced from the open pit part of the mine. And the 8% royalty is basically, that's the tax regime that Guyana has for gold mines. They say you have to pay an 8% royalty in addition to the tax on corporate income. And I think G Mining has negotiated the royalty for the underground portion of the mine down to 3%, because that is not in the official code, just says 8%. But they managed to convince the authorities that for the underground portion, they can get a lower rate. So they managed to get the 3%, and that's why G Mining says the blended tax rate, the blended royalties are for both the open pit and the underground portion of the mine in Guyana is 6.4%. But it's, by the way, just to give you some background on that one, it's quite common for many countries that you have this normal corporate taxes on mining companies, but it's also relatively common that you have a royalty, because they know it's profitable, and the royalty helps in a sense also the mining companies because they have to pay based on the gold price. Yeah, as an example, many countries in West Africa have like 10% royalty. Yeah, Mongolia has a 5% royalty effectively. So it's not very uncommon.
Is there royalty on TZ as well? I mean, to the
Yes,
government?
yes, but that's a very small one. I think it's like 1.5% or so. And then they have another royalty from a royalty company. I forgot the name of it. That was also like 1.5%. So they have in total a 3% royalty on TZ.
Okay. So with Guyana, I mean, I'm guessing, are there a lot more risks, execution risks, the project management, property rights, etc., getting permits?
Yeah. I mean, basically let's start with the permit because that's the most near term. So as I mentioned before, they got a preliminary environmental permit in January this year. And they expect within weeks to get the final permit, to build a mine. And what is also interesting is that the president of Guyana met the CEO of G Mining last year in April before they acquired the deposit. And the president of Guyana has also met with other companies exploring for gold in Guyana. And he explicitly stated that they're very interested to open up gold mines and other mines in Guyana, because it provides job in typically remote areas of Guyana. I mean, Guyana, as many of you may know, has this big offshore oil boom, that Exxon and Chevron are involved in. So this provides a lot of tax revenue and also a couple of highly qualified jobs on these offshore oil platforms, but it's all at the coast. While in the remote areas inland of Guyana, there's really not much opportunity to benefit from this oil boom that is all happening offshore. And that's why the president specifically said he wants to really encourage mines to be built. And he explicitly even pushed G Mining to build a mine as fast as they possibly can. He explicitly said that to them in the meeting last year. So I think it's from a permitting risk, it's a very low risk that they would not get an environmental permit to build that mine.
And this mine, because we've said it's going to cost about $1 billion.
Mm-hmm.
Is there going to be any potential shareholder dilution or raising of debt, or is it going to be built from organic cash flows? What have they said anything about this?
Yes, they did quite detailed. Actually, in the latest corporate presentation from June, they have slide 29, where they show basically how they want to fund OrcoWest. And when they use $3,000 as a price assumption for gold, which is of course about 10% lower than where it is now, then they say they expect to need about $400 million in external funding. But the $400 million for external funding is also there to basically pay back roughly $100 million in debt that they currently have from the first mine. So effectively for OrcoWest, it would be only net $300 million. And they say they plan to get $50 million for equipment financing and $350 million for a corporate revolver. So a corporate revolving credit. And then they have enough funding available, including more than $100 million buffer to build OrcoWest. And that means basically they just need a little bit of debt externally. And because they produce so much free cash flow from the first mine, from TZ, that they don't need to issue additional shares to build a second.
So yeah, it is slide 29. It's if you go to investors, presentations, in events, it's on the downloadable presentation on the left side of the website.
Probably hear about this in the next few months, because before they do the construction decision, they have to put the financing in place.
Okay. Yeah, there's lots of good stuff actually on their website. So for those of you who are interested, should go to G Mining Ventures website. Their investor relations is pretty good.
Mm-hmm.
There's lots of information. I mean, their corporate presentation is good. I saw some of their projects. They got the feasibility studies on there. It's a very, very decent website. I'm not into miners, but I have looked at a couple of mining websites, and this is probably the best one.
Yeah, it's a very good one, definitely.
So, okay, I was just checking here the questions that came in. I think we've addressed addressed all the questions as in shareholder dilution, task risks, Guyana.
I think there was something with regards to labor force in Guyana. I saw something. So basically,
Yes.
I mean, labor force basically, sure, Guyana is not a huge country. Yeah? So it has like 800,000 inhabitants and it has this oil boom at the coast. In the inland where the mine site is, it's very sparsely populated. What you need to know though is that the mine that G Mining is building in Guyana doesn't need that many employees. Yeah, so they estimated in the feasibility study that they need about 1,270 permanent employees to run the whole mine, and that means they can produce 350,000 ounces of gold per year with less than 1,300 employees. Yeah, and that gives you basically revenue per employee of about $1 million. Yeah, so it's a lot of revenue per employee. And as a result, as an example, if they need people or they will need people to run these mining trucks, these 150-ton, very heavy trucks that basically transport the ore from the mine site to the processing plant. If they come in and say to some truck drivers that, drive 40-ton trucks on the highway and say, okay, we give you training that you learn how to operate these big and heavy machines, and then we pay you double the salary, I'm pretty sure they will find people willing to do that, and they can easily pay double the salary of a normal truck driver, with the revenue they generate with that mine. So what I see typically is that miners operating in countries like Guyana or other places where the average salary in the population is not that high, very often have by far the best salaries in the country. And that is why very often they actually can pick and choose between who they want to employ, because a lot of people, of course, say, well, of course, I would like to work for the company if I get, 2 or 3 times my normal salary. And in particular in regions that are pretty remote, where you don't have many good jobs. So, I think labor supply should be, given the salaries they can pay, should be not an issue. Yeah. It was labor issues I noticed from miners were happening in places like Australia, where people had a lot of options, in terms of where they want to work and how much pay they want to get, etc. But not really in countries like Guyana and other more emerging markets.
Okay.
And then in terms of, I think there was also, there was one question related to Guyana, or not related to Guyana, but related to some restatement of the financial statement that the G Mining published in May.
Yes.
And that was a bit unfortunate, but basically they had an accounting issue. Yeah? So they had to do a restatement of the 2024 result because they had some negative Forex effects that they recorded, but they recorded it in the comprehensive income statement instead of the consolidated income statement. Yeah. So it's not like they forgot about it, they just recorded it in the wrong income statement. And as a result, of course, then the numbers look different. But if you look at it in detail, I mean, first it was a Forex effect. So it was just currency fluctuation between US dollar, Canadian dollar, and Guyanese dollar and Brazilian real. So it wasn't really from operations or mine build capex or anything like that. And then it was, as I said, it was not that they forgot about it or so, it was just recorded in the wrong financial statement. So to me, it's like, it's unfortunate that that shouldn't have happened, but it's not like affecting the ability of the company, the cash flow, capex, or anything like this. And so for me, I don't see it as a red flag to say, oh, they might not be as good as we thought they are.
Okay. So, the gold miners, they're not their typical company where you do a DCF and then you have a terminal value calculation, assuming it's around forever. This is more of a corporate finance NPV case, is just because the mines run out of gold.
Yes, the terminal value is zero.
Yeah, there is no terminal value. Exactly. So you have to make some assumptions. You have to look at it as a project rather than as this living forever entity.
Yes.
So the big assumption here is the gold price, and then the other one is the cost of taking the gold out. And miners, due to the World Gold Council came out with a specific definition for this cost, the AISC. see. So the
all-in sustaining cost.
All-in sustaining cost, which pretty much I think has almost everything included. Is that right? Except for expansionary capex, depreciation, finance, and tax. Is that right?
Yeah, pretty much.
So it has like the labor cost. It has like the cost of sustaining that capex.
Yes.
The maintenance capex would be probably
Exactly.
better. The maintenance capex for being able to achieve that production. But at the same time, I guess the mines themselves also have a little bit of an expansion capex. Is that right?
I mean,
or
in the case of G Mining, Oko West is in that regard a bit special because it actually has two parts of the mine. It has an open pit part and it has an underground part. And the open pit part is built, or at least it goes into production first, and then the underground mine goes into production over time. It also takes much longer to ramp up because you have to build all the access roads and ramps and decline and all that stuff. So actually what you have, and the company has this also in its slides, you have roughly these 972 million initial capex until the first gold is produced. And then you have another $650 million that needs to be spent afterwards in sustaining capital. And a big portion of these 650 million is for the underground portion of the mine. Yeah, and that's all included in the all-in sustaining cost. Yeah, so basically from the moment that the mine produces gold, all other capex that is coming is then sustaining capex, and that is included in the all-in sustaining cost.
Oh, okay. So the 650 million of the maintenance,
yes,
whatever capex or sustaining.
Yeah,
I guess sustaining is not really maintenance, but it's also
building
basically
the underground
capex.
mine.
Yeah, to get that promised production.
Yes.
So the one issue I kind of see a little bit of an issue is that if you are doing your NPV in Excel and then you might look to the financial statements it won't match up. You'll have these like differences, and I'm just wondering, in your experience, has that been an issue or not?
Yeah,
because you'll have, because it's because of all these different timing issues and all these like little other things and forex. It's like all these other things can add up. So I'd like to hear your comment on that, and if these things worry you, and how do you how do you deal with that?
Okay, let's start with the forex because that's the easiest one. So basically, forex is the only real forex risk you have is if the currency of the country your mine is operating in gets stronger versus the US dollar, because then your operating costs go higher, but the gold price doesn't compensate you for it. Yeah. If on the other hand the currency gets weaker, you actually benefit. Yeah. So and that may not be at all reflect the way it's reflected in the financial statement. In the financial statement, it might say the Brazilian real fell, so your investment you made previously now has a forex loss. And I'm like, I don't care at all. It doesn't matter. It's totally irrelevant for me as an investor in terms of what cash flow I get. Every day I see the Brazilian real get weaker versus the US dollar. I'm happy because I know that their local costs actually decrease versus the US dollar. It's the same for all the other mines. Yeah. So you only benefit if the local currency gets weaker. I mean, of course, there's also limits. Yeah. I mean, if they have a serious currency crisis, then you typically also get higher inflation locally. And if it gets really bad, then you might suddenly get capital controls and other things like they had in Argentina. So it can also get extreme. Yeah. But as long as you're not getting in a very dire situation, you're actually fine. Yeah. So that's the only real currency risk is either the currency gets stronger versus US dollar, or they go into such a disastrous currency crisis that they then suddenly introduce capital controls and other measures, which then make it difficult to get your money out. Yeah, if you produce gold and you get cash flow and suddenly you can't send the money abroad, then that's an issue.
Okay. So I guess going back to our net present value, one thing I noticed with these feasibility studies is they're using a 5% discount rate, which throws me off. I said to myself, I'm not going to use a 5% discount, right? Are these people crazy?
Yeah. That's an interesting thing. So basically, the mining industry has standardized on certain discount rates. Yeah. So the gold miners, they all use 5% discount rates in their technical studies. Not just G Mining, but basically all gold mining companies. If you look at the copper miner, they typically use 8%, copper or the base metals. Yeah, they use 8% as a discount rate. And now, of course, you might ask, okay, how did they get to this 5%? Yeah, and of course, the gold miners will say, well, gold is basically sort of an inflation hedge, and because our revenue is gold linked, we effectively have something like a real interest rate if you discount it with 5%, because we are not getting fiat dollars, but we are producing gold. Yeah, so any increase in inflation will be reflected on a higher gold price. But of course, you can also argue that, yes, I see this, but you're operating a mine, you're building a mine, and this is risky, and it has many, many risks. Yeah. So 5% is probably too low, or for sure too low as a discount rate for a gold mining project. Yeah. So what I do is I look at the company, look at its track record, and look at the type of mine they want to build, and then say, okay, what is an appropriate discount rate? Yeah. And in the case of G Mining, I'm using 10% across the board. For discounting the cash flows, yeah, so for TZ and also for Oko West. For other mining companies that are in an earlier stage, like an exploration company I invested in Argentina, I use a 13% discount rate because it's at the earlier stage and there's higher risk involved.
So does G Mining have a lower production cost versus
yes.
other?
Yes. Actually, they have a slide somewhere. They estimate that they are very easily in the lowest quartile. Oh yeah, it's in the same presentation, the corporate presentation, slide 19. They show the gold mining cost curve, all-in sustaining cost curve globally, and they say they're roughly in the middle of the first quartile. Yeah, so that means more than 80% of the mines worldwide have higher production costs than they do.
Yeah, I see that. Yeah. I actually, I was going to ask you. I forgot about this. I had seen this slide, and there's so many lines here. Are all those lines gold mines?
That this could very well be. I mean, there are roughly 1,400 gold mines operating worldwide. In operation.
Okay. And like we said, we take the gold price, we minus the AISC, which is something we can use guidance. If you want to be conservative, I guess you could put some inflation to that, but it's probably going to be offset by the gold price. And we can that would give us our gross margin, which would multiply by the production, which is also given to us as an outlook from the company. Now, the one issue is that from that production, I think, what is it, 12.5%?
The stream, yeah.
Yes, we haven't talked about the stream. So
yes. Okay, so that's an interesting one. So basically, when G Mining organized the financing for its first mine in Brazil, they had no cash flow, obviously. So they had no other operating assets. So they needed to find a way to get the capital to build a mine. And basically, as a mining junior, you have three options. You can raise debt, you can issue shares, or you can get a royalty or a streaming agreement. So actually, they did all three. So they did a deal with Franco-Nevada, the biggest gold mining royalty company worldwide, to sell 12.5% of the gold produced at TZ every year, to sell that gold to Franco-Nevada at 20% of the spot price of gold. Yeah, so Franco-Nevada gets an 80% discount on the price of gold that gets produced in the first mine in Brazil. And in return, Franco-Nevada provided $250 million to finance the construction of the first mine. And just to give you an idea, $250 million is more than half of the roughly $460 million cost capex to build the first mine. Yeah, so they were able to finance more than half of the mine capex with this stream. And when I looked at it in detail, I think it was a very good deal for G Mining to finance it this way, because they otherwise they would have had to issue a lot of shares in combination with debt to finance the mine if they wouldn't have been able to get that streaming.
Well, I mean, it's still good for them. I mean, for Franco-Nevada, because I'm just making a rough calculation here. It seems that they're getting 12% of the TZ mine, and they're saving 80%. and current gold price of about 3,400, that works out to about 60 million a year.
Yeah, sure.
So,
at the time when the stream deal was done in 2022, gold was below $2,000. Yeah, so
true.
I agree. But on the other hand, what is interesting is that royalties and streams have a higher value in the market than revenue of a gold miner. So that's why when a gold mining company needs really money to finance a mine, so they have no other sources of capital, they don't have cash flow from other mines, it is normally more profitable and less dilutive if they can get a royalty deal or a streaming deal for the construction of the mine versus if they have to issue shares. Yeah, that's the way these royalties are valued.
So wait, do they have to pay the 250 million debt as well as give them the royalty?
No. The 250 million are not debt. They basically just have the streaming deal with Franco-Nevada. So they have to give 12.5% of the gold that they produce each year to Franco-Nevada at this 80% discount to spot. But that's it. Yeah. So they have no other obligation. They have, in addition, they made a senior debt with Franco-Nevada of $75 million, but that's independent of the streaming.
Mm-hmm. Now, what's interesting is gold, even though it's been making new highs, it may not have even rallied yet.
Sure. I mean, I look at a lot of data, but one of the really good sources I would recommend is a report called "In Gold We Trust," that is published by an asset manager in Austria every year. A big report, almost 500 pages on all kinds gold related, and they also have always one chapter or several chapters with regards to valuation and forecasts based on certain valuation metrics. Yeah, and they have pretty interesting track record because they published in their 2020 report, they said they would expect that gold would do very well this decade, and they published a forecast that said when gold was $1,600 roughly in 2020 or so, or $1,700, they said, well, they expect gold to go to about $4,800 by the end of the decade, by 2030. And we are pretty well on that path that they projected. Yeah, so 4,800 was their base forecast. They also have a more aggressive forecast in case we get significant waves of inflation coming back, which goes to $1,900. And well, basically, what they also publish, I don't have it now right at hand, the right page, but what they publish is a lot of indicators also, as an example, gold versus government debt, or gold versus M2 or M3 and stuff like that. And if you look at these figures, you realize, okay, yes, gold had a pretty good run over the last few years, but it's nowhere near any extreme where gold peaked in previous bull markets. Yeah, so we are still pretty far away, and so their assessment in that report is we're probably halfway through, or maybe in the third quarter. And what is also interesting is in historic bull markets, they typically go sort of parabolic in the end. So that means you have then really rapid price increases, and you also notice it in other metals. So silver should also have a significant bull market when you're in the late stage of a gold bull market. We haven't seen that yet. And the gold miners also should be extremely popular. We haven't seen that yet. I mean, they start to get more popular now, over the last year. But I mean, it's nowhere near a place where, everybody wants to invest in gold mines. Or people ask you about gold mines, not at all. So it's still, especially retail interest is not that great yet. So you're not yet in the late stage.
I actually found it. It's in goldwetrust.report.
Yes.
On the internet. So, but what about when gold wasn't doing so great? I mean, have you looked back at all to see how their previous forecasts have been when gold wasn't doing anything? Because I think gold has gone like in periods of like a decade where it did nothing, just fluctuated.
I mean, even worse. I mean, of course, if you probably the worst moment, if you invested in the early 1980s in gold, you would be in like a 20-year bear market. So, I mean, they haven't published a report that long. I think they published it, started in maybe 19 years ago or so. And to be honest, I did not check I'm reading it for the last 5 or 6 years now. Yeah, so I did not check the very early versions to see, what type of forecast did they do.
Because there's like when you call your publication in Gold We Trust, there's an obvious bias there.
Yeah, sure. No, for sure. I mean that there's no doubt about it. But what they also say, to be fair, I mean they also it's very nuanced. Yeah, so they're not always extremely bullish in terms of you should buy now indiscriminately. They even in this year's report they even say they expect gold moving sideways or maybe even down for a couple of months, yeah, because that would be a typical pattern, yeah. So they're not purely marketing, yeah. You see, they put a lot of research into it and a lot of nuance, and they also are looking at other assets like silver. They also look at gold miners, etc., and where they are and how attractive they are. And by the way, last but not least, not in a lot of detail in that report, they also look at Bitcoin. Yeah, so it's an interesting, interesting report and interesting source.
Yeah, because if gold, it changes the whole economics. If it dropped like $1,000, I mean, the whole project would be worth half of where it's at.
Easily.
I mean, maybe this opportunity exists because you need to be compensated for the risk. Having said that, it seems that the other companies are more fairly valued, at least if we're looking at consensus versus market price. So I'm just wondering if it makes sense to be long G mining and then short, a basket or some competitors which are, I don't know, in debt or something. I don't know if you've thought of that angle, but by doing that, you would sort of offset the risk of getting hit by gold, and then you're playing more of this expansion, I guess, of G mining. And a bet on the management and the projects rather than the underlying commodity. And you wouldn't have to go 100%. You could go maybe a partial just to reduce your risk. I don't know if you thought about that at all.
Yeah, I mean, I don't short just for risk purposes, but in principle, yes. The problem, I mean, the issue, I would do another strategy in that case. What I would try to do is I would look for really crappy companies, yeah, really bad ones, and then short these. But the problem is even this can go horribly wrong, because in the very late stages of a bull market, normally the most crappy company will outperform the higher quality one. It would be a really bad experience. Yeah, so the short answer is no. But I mean, one thing you could in theory do is you could go short gold and long the gold miner. Yeah, but somehow it's weird, because I mean, how should I say, if you don't have enough conviction in the commodity, I wouldn't invest in it. Let's just say it this way.
So okay, so we've taken care, I think, of operating costs and operating income based on what we've discussed. And what are you using for, if you don't mind sharing, what are you using for finance expense? Are you just, I think they had about 5 million in the first quarter.
Yeah.
Yeah.
I basically take what they have published in their financial statements in terms of how much debt they have and how much interest they pay. Yeah. So as an example, for the first mine that they built in Brazil, they took out the loan from Caterpillar for equipment financing, and they say currently they have about $32 million outstanding. And then they have a senior loan from Franco-Nevada of $75 million. Yeah. And I know they have published the interest rate that they pay on these loans, and I basically use these numbers to estimate or to calculate what is the interest they have to pay every year, and by when do they have to pay it back. Yeah, that's okay. The way I model it.
Okay, and depreciation, because then you have a tax benefit, I guess. It's not big, but I guess, what are you using there?
Yeah. I do calculate EBITDA depreciation for basically profit before tax to be able to then apply a tax rate. Yes.
Okay. Do they provide guidance on that? Or I know depreciation was in the first quarter was something like 14 million.
Yeah, I mean, this one I don't do in detail per year. And the reason is it's pretty complex, because the mining,
yes.
Or how should I say, certain tax laws allow you to have accelerated depreciation for investments. Yeah, so you can suddenly depreciate, I don't know, over pretty short time period the whole capex you have done, which means then of course you have a lot of much less income tax. But this gets so complicated because every country is different that I don't do it. I just say, okay, I use a uniform tax rate over the lifetime of the project.
Yeah, I guess you could say, how much did they spend on the project and then divide by 10 because this is, 10.3 years or 10.5 years or something. So you could just do that and do a straight line and come out with a valuation for that.
And I mean, what I also do is, of course, I build the model on an asset level and then look at what they publish in the feasibility study, because what they also publish in the feasibility study is not just one value, but they also publish the sensitivity depending on the gold price. And then I can test my model and say, okay, if I use now different gold prices, do I get the same values like they have published in the feasibility study? Yeah, so I can verify my NPV model with what they have published in the study, basically.
So when you do an NPV for TZ, I mean, what do you get? I mean, if you don't mind sharing.
Yeah, sure, no problem. Okay, so $3,300 gold, that gives me a net present value for TZ by 1st of July this year of $2.3 billion, discounted at the 10% discount rate.
And then Oko West starts in 3 years' time at 350,000 ounces, again with 3,300 gold price. What do you get for that?
Yes, for Oko West, also with a 10% discount rate, discounted to 1st of July this year, I get $2,362 million. So a bit more than 2.3 billion.
But you get 2.3?
Yeah, a bit more than 2.3. Yeah.
Okay, so you get 2.3 and 2.3.
Yes.
Okay, so you come out to about 4.6. I think when in the article I did, I was like doing some rough calculations and I came out with 4.5. So it's pretty much in line with and yours is a lot more sophisticated model than mine. So, and that's what's kind of interesting with this. You don't really have to, even with some basic stuff, you pretty much come up with the 4.6 billion just with the outlook and what's in the financial statements.
Yeah.
And so it's really is a bet on gold here. And what that works out to then, if you put 4.6, I'm guessing, what is that in, but that's in US dollars.
That's in US
of course.
dollars.
So keep in mind, G Mining, for the listeners, trades in Toronto and trades in Canadian dollars. And $1 US is around 1.37 Canadian. So we'd have to take this 4.6 billion and multiply it by 1.37 to get about 6.3 billion Canadian. And then we divide that by, what is it? 226 million. Well, there's some debt as well, debt and cash, but I think those are irrelevant.
Yeah, actually, the debt you can forget because it's all going to be goes away over the NPV lifetime. Yeah, so the debt is basically netted out with the NPV.
Oh, yeah, and plus they have the cash which offsets it anyway. So that, like, I just typed in some numbers here. It comes out to, what are you getting, like $28? Is that right?
Almost, yeah. It's roughly 27 and a little bit more than that. Yeah.
Yeah. So $27, $28 net present value for Oko West and TZ using a 10% discount rate and 1.37 Canadian dollars. Significant. That's about $10 upside to where it trades now. It's 18, about 18 now. So if you were just to take 27 divided by 18 is about 50% upside.
Yeah. And what is not included in these numbers is two things. One, obviously, the third mine has zero value because they haven't published any detailed information to be able to do an NPV. And what is also not included is any mine life extension for the mine in Brazil and the mine in Guyana. Yeah, and the mine life extension is actually highly likely. To give you an example, TZ, the first mine, produced 63,000 ounces of gold last year, but they found 73,000 ounces with exploration last year. So they basically just extended the mine life for like half a year or so with the additional exploration. And they continue doing exploration, on all three assets. So it is very likely that they will be able to extend the mine life in Brazil probably by 5 years at least.
Oh, wow.
Yeah, and the one in Guyana is probably going to be even more, because they took out that slide in the current investor presentation, but they had one in previous investor presentation that shows that this type of geology that they have with the mine in Guyana is famous for growing deposits. So they have in earlier presentations shown two other examples, historical ones, where a mine had, initially 4.7 million ounces prior to commercial production. And then since 2004, a different mine. And then since producing 20 years ago, the mine has produced 6.1 million ounces and has almost 5 million in the reserve. So basically, they have more than doubled gold in the ground, including production, versus what they found prior to commercial production. And there's another example where it increased by 50% over 5 years, or a bit more than 5 years. And they have actually with Oko West, also interesting, the first resource information that was given, or the resource estimate, was 4.3 million ounces in June 2023. And in February last year, they made an update and they said now they have 5.9 million ounces already. And they continue exploring. So,
oh, wow.
I would actually expect that Oko West can easily double over time. So they will produce a long time. In addition, the land package they currently own is not all there is. So there are adjacent exploration licenses that are available, and the company acquired some of these exploration licenses last year and made deals with the owners of the exploration licenses in terms of royalty deals. So they actually have been able to extend the exploration package that was 44 square kilometers when they acquired the project last year. They extended this to 71 square kilometers. And in addition, there is one exploration license, a big one in the north of their project, that is owned by another Canadian company. And this Canadian company already found more than 2 million ounces on their property. So it's very likely that, first of all, there's much more gold in exploration licenses surrounding the mine. And at some point in time, G Mining is very likely to just buy out some of these licenses. Some of them, which are relatively small, of course, will be cheaper to buy. The company in the north will, of course, charge a lot of money for what they have found. But still, it's economic because G Mining is the ideal acquirer of these licenses, because they build a mine, they build a processing plant, they have all the infrastructure there. So for somebody else, it makes no sense to try to build their own mine for their little deposit or smaller deposit than what G Mining has, versus just saying, okay, let's agree on a price and we sell it to you. That's why I think, most likely Oko West will produce for decades. That's the most likely outcome.
Wow. I mean, you got 10 years, imagine that TZ goes to like 15 and Oko goes from 12 to 18. And then you've got the Gurupi mine. And so, you can be talking about an NPV of a lot higher.
Yes.
A lot higher than 28. And then you also have the issue of gold price could be $1,000 higher.
Yes, and in addition, last but not least, I didn't mention this, there's another upside. Let's close that one first. So I did a very rough estimate to see, okay, what is the value of this optionality in terms of extending mine life and the third mine, Gurupi. So, and the very rough estimate was that they could add another 25% in net present value just by extending the mine life of TZ and Oko West. And I think that is a very conservative estimate, but I say, okay, let's be on the safe side. And they could add another $900 million in NPV if they build a mine at Gurupi. And the reason I believe it's roughly, or could be in that ballpark range, is because the deposit at Gurupi is roughly 2.6 million ounces, while the mine, the first one in Brazil, is 2 million ounces. So it's already bigger than the first mine, and they do more exploration now. So I said, okay, I make a significant discount to the net present value of the first mine of 60%, but I still get then $900 million in NPV for Gurupi. So that means in the end, I get a total net present value of roughly 6.8 billion US dollars, and that would mean a share price of roughly almost 40 Canadian dollars if they can execute on these options and extending the mine lives. So that's the one thing. And the other thing is the company explicitly says they are not going to be only an intermediate producer. I mean, intermediate means 500,000 ounces production. So they say, okay, now they have a pretty clear timeline. They're going to put the second mine into construction and production. Afterwards, they will progress with the third mine. But even then, the target of the company, and the CEO clearly said that in interviews, is to become a gold miner with more than 1 million ounces of production. Yeah, so it's very likely that they will acquire more assets, even after Gurupi, to build a fourth mine and further mines. And then, of course, the question is, okay, how much do they pay? Is it economic expansion? And there, as let's say, so far the track record is very good. So far, all the assets they have acquired have an unbelievable return on capital employed. Yeah, as an example, for Brazil, they paid a total of, for the mine capex and for acquiring the asset for the first, basically the deposit in Brazil, they paid a total of roughly $600 million. And the free cash flow of that mine, of course, with a higher gold price by now, the free cash flow per year is, let me check, is was roughly $300 million per year. So they have like a payback period of 2 years and a 10-year mine life without extension. And Oko West, based on my calculation, is also a good investment. So if they continue to acquire assets at attractive prices and then build those mines, because that's what they have proven they can do really well, they will actually add even more value. But that's more like a longer term outlook. Yeah. So for now, I would just say, okay, let's assume they build Oko West. Let's assume they build Gurupi at some point in time. And with an outlook of 3 years, I think the shares could easily double or triple at the same gold price like today.
Well, yeah, and we're talking more of like something like 750, 800,000 per year if we add those together. But the management, you said, was like they're visioning 1 million.
Yes.
So then you're gonna do 20% at least on top of that. So it would take our $40 to like $50 now. And so our the $18 now becomes like a multi-bagger.
Yeah, that's true. I mean, there's one interesting shareholder, which is La Mancha, the biggest institutional shareholder of G Mining. And these guys have a lot of experience in investing in gold miners and making them grow. So they invested in a company called Endeavour Mining, which has built mines in Africa.
Yeah.
And they had this playbook. So they basically started with one mine and then used the free cash flow from that mine to acquire a second one and build a third one. So this one, actually, they built from basically the first mine to a 1.4 million ounce producer. Yeah. And they say, okay, the goal is with G Mining, they want to do the same playbook. Yeah. So we'll see. It's not totally impossible.
Well, this is fantastic. I mean, Samir, I'm just looking at the clock now.
Yeah.
It's like 2 hours of talking about this gold miner. But you know what I loved about this? We've really provided so much information for people. I think we should leave it at there. And let people go and do their own due diligence. Obviously, as always, this is for educational purposes only. For those of you who've been for the first time, you can check out some older podcast episodes where I have some other pretty smart people like Samir, and these are all people that I've met over the years who've come to my event in Cyprus, and I'm going to do something online next week. So I'll put a link in the notes. I hope you guys will join us. Samir, thank you. Thank you so much for coming. One last thing, I forgot. Is there a way for people to contact you if you? I mean, do you have a Twitter or something, or
no, I don't. I'm fine. You can put my my contact details, basically my email or my LinkedIn profile, in the notes of the episode. That's fine. And
okay, I'll put your LinkedIn, and people can reach out to you on LinkedIn. Then,
sure.
Is that okay?
That's good.
Okay, great. So you can look up Samir Mohamed, and I think the one thing we didn't mention is that you're actually Swiss, and people are probably being confused with the with the Samir. You are Swiss of Egyptian descent.
Exactly.
So for those of you wondering, so thank you, Samir, for this amazing podcast episode. Is there anything you'd like to add, or will?
Happy to contribute, always fun. I also like the conferences in Cyprus a lot, yeah, as you know. So I encourage anybody who has a chance. And I would recommend to everybody to join the online conference, because based on my experience with all the in-person conferences, I can assure you that the content or the quality will be fantastic.
Right. Well, thank you, Samir. Have a good weekend.
You also. Thanks.
The podcast episodes should not be copied, distributed, published, or reproduced in whole or in part without the prior written consent of the host. These recordings are for informational purposes only. This recording does not address all risks. The podcast is not intended to be relied upon as a forecast, research, or investment advice, and are not a recommendation, offer, or solicitation to buy or sell any securities or to adopt any investment strategy. The views and opinions of any podcast participants are subject to change and are not necessarily those of any companies affiliated or associated with the participants. The participants cannot guarantee the accuracy of the information in this podcast and has not independently verified the accuracy or completeness of such information or the assumptions on which such information is based. There is no guarantee that any forward-looking information will come to pass. Reliance upon information on this podcast is at the sole discretion of the reader and/or listener. Past performance is not indicative of current or future results. This podcast is being made available for educational purposes only and should not be used for any other purpose.